Hi, welcome to the CTO-CTO podcast. In today's episode, Piotr speaks to Brian Flynn, serial entrepreneur and investor at FounderPartners, who has over 20 years of experience in business and startups and over 10 in investments. Piotr and Brian have a unique conversation about building companies, all stages of funding, the difference between unicorns and mustangs, and why letting go of your own ego and focusing on your customers when it comes to your company's growth can actually be the most beneficial in the long term. Brian also shares the mindset that led him to a couple of multi-million exits for the companies that he founded. Last but not least, you will find out what being a jet pilot, Iron Maiden's lead singer, and startups all have in common. Tune in.
Hello everyone, I'm super excited for today's episode. I'm hosting Brian Flynn of FounderPartners. His career started at the eve of the internet bubble burst in the end of 90s, Silicon Valley, mergers and acquisitions. Then it only got better. Now Brian is leading FounderPartners, which is very different kind of financial services firm where it builds and sells tech companies. He's looking more for mustangs than unicorns. And what does it actually mean? What makes a great exit and how long it takes to have one? Let's begin and try to answer those questions. Hi Brian, thank you for accepting my invitation.
Hey, Piotr. Great to talk to you today. Feeling awesome. I may have had a little bit too much coffee, so bear with me.
That's awesome. Let's start with some really basic question. I always like to ask it. It is like, what was your path to entrepreneurship? How you started?
Yeah, I wish I was the kid who was 3 years old and loved pets and knew right away that I was going to be a veterinarian. I had no clue. The only thing is that the best thing I probably ever did was I was a philosophy major in college. So I was always a truth seeker to try and figure out truth.
Truth seeker, yeah.
Yeah. So that kind of helped me. My path to entrepreneurship was circuitous. I started out as a Wall Street M&A banker when it was actually cool to be a banker. And then I've turned into an entrepreneur. So in other words, I learned how to sell a business before I learned how to buy a business. And I can get into as much depth as you want about that as possible.
Yeah, that's good point. I mean, people starting the companies without clear vision how it's gonna end up. And everyone who read books like Build to Sell or this kind of, myth, like entrepreneurship myth and other books like this, putting the right perspective, I think that they have advantage, right? Because they knew perfectly well why they are doing it and what is the end game. Do you agree with me? Or maybe it's the wrong way?
I totally agree. I think, at the end of the day, and now we're getting philosophical here, people need to be authentic. They need to follow their passions. I didn't know I was actually meant to become an entrepreneur. I was just a really hard worker, and I, work more out of fear, probably like a lot of other people. I did well in school, and, I tried to, back in the early 90s, get the best possible job. And back then it wasn't working at Google. Back then it was working at Goldman Sachs or Morgan Stanley in New York in the M&A department. Why? Because they recruited for certain type of schools and a certain type of personality, and they paid the most. So I guess I was motivated by money back then, and also to learn as much as I could. So that's how I entered my career. But that was a 7-year journey in Wall Street.
Okay, so after 7 years, you finally landed in Silicon Valley, Robertson and Stevens, head of internet and software M&As. And actually it was, the eve of the internet bubble burst because it was end of 1990s. How was it? Tell us some cool stories.
Yeah, so there's some great stories. Let me just kind of make a quick change. So I did actually 3 years in banking at Morgan Stanley. I got my MBA. I came out to California. And I still had my MBA debt.
Yep.
So I still didn't know what I wanted to do. And I joined this firm called Robertson Stevens, and I didn't know anything about the internet because when I graduated in 95 from business school, this, thing called...
It wasn't a thing. Yeah.
It wasn't a thing. But this firm, Robbie Stevens, one of the reasons why I joined it is it was one of the 4 horsemen in Silicon Valley. And there were the four of them were Robbie Stevens, Montgomery Securities, Alex Brown, and Hambrecht and Quist. And these firms were out here in the Valley when Morgan Stanley, Goldman, all the big bulge bracket firms weren't out here. And they were taking all the big, awesome tech companies public, from Microsoft to Adobe, to you name it. And when I joined Robbie, again, I was lost, wasn't sure what I wanted to do long term. I jumped in. I was like, a bunch of smart people going to pay off this debt. And 3 months into my job, Robbie was one of the firms taking Netscape public. And I was like, holy smokes. Yeah, it was crazy. And before I knew it, I was working really hard as part of this firm that grew to close to $1 billion in revenues, taking all sorts of tech companies public. I got this great opportunity. I kept getting promoted to run the software and internet M&A practice. And we were just doing deals after deals after deals. Small deals, big deals. Every deal was almost a good deal as long as it paid a fee, frankly. Yeah. But the reality is that it was, a lot of these businesses that were being taken public and being valued were not being valued based off of fundamentals. It was more fundamentals, meaning cash flows and revenues. And all. A lot of it was just like eyeballs. It was crazy days, even more crazy than what we've seen during the crypto days, practically. Yeah. So anyway, long and short of it is that, after doing M&A and also at Robbie Stevens for 7 years, I realized I was very good at what I did, but I wasn't super passionate. And this always circles back to finding out who your true self is. And what was great is that by working at Robbie Stevens, as opposed to Morgan Stanley, my clients, I was actually helping them, facilitating them these big exit events. And I got to learn about entrepreneurship. I got to learn about tech. And I was thinking, well, wait, maybe the grass is greener. If these guys are in their 20s and I'm in my late 20s, why the heck can't I do this? And that was my leap into entrepreneurship. And I did a bunch of companies back to back, which we can talk about.
Gotcha. So what you just said is that you had a great chance in your early career because, it was, early years of your professional career, actually, to see how the end game looks like. Like, why do you start a new venture, new company, why you are an entrepreneur. What does it mean to exit? How it look like? What is the process of finding the acquirer and so on, which will lead us to the FounderPartners. But before we land there, tell me a little bit about the Macromedia, because it was also I suppose it was your next step after Robinson and Stevens?
No, it wasn't actually. So I became an entrepreneur after I left Robertson Stevens.
Okay, so you founded a company.
Yeah, so I founded two companies back to back. The first company was called Ultras, and Ultras was what today is Quora, which is a huge internet company. And it was done 15 years before that. And it was pretty much bootstrap. We only raised $1 million. We had all the same challenges of getting traffic. The people would answer questions versus people that would ask questions, not to mention how to monetize the business.
It was long before Web 2.0, right? So user-generated content wasn't a thing as well. Huh.
Exactly. It's way before the day. And, we had all sorts of challenges like any business. And it was my first one that I was working with. But I was able to help the team pivot the product from a consumer one into an enterprise one. So imagine Quora for the enterprise, because to us, that's where the money was. Companies would pay for that. And once we changed that product strategy, I used my M&A skills in a BD capacity and was able to get 4 different M&A offers. They turned into BD, but then they quickly turned into M&A offers and sold that business for $14 million. That was a 2-year journey. We almost ran out of capital, but our investors made almost 7 times their money in 2 years.
It's a huge success.
It was good, but I kind of had a little nervous because I didn't know exactly how to build a real business. It actually wasn't until my third one, which we could talk about later. The second one I did was in the internet doldrums, or like the COVID-19. of 2001. So the internet had busted. My co-founder at the first company, technical guy, had this idea in the security software space. And when we looked in security, the only thing that where there was white space was there was instant messaging. So IM was growing faster than email was as a communication medium back then, and there were no security software solutions around that. We started a company called IM Secure, security software for instant messaging, found product market fit in the financial services world where block traders were.
You are doing something like Signal right now, but 20 years ago.
I like your themes. I guess that's right. Yeah. And there, we got our first license from Bank of America. But then I didn't know that there's this thing called procurement due diligence, which is very different than M&A due diligence. And they found out it was me and a few guys in Palo Alto with a dev team in the Ukraine, which was very novel back then in 2001.
You mean the vendor assessment process where the buyer of your license is trying to figure out if it's a safe choice, right?
Exactly. And you look at...
And outsourcing was something out of their minds.
Out of their minds, not to mention the fact that we only probably at that time had like $20,000 of cash in our balance sheet and we were going after...
Sounds like a reliable partner for a Bank of America.
Exactly. But here's the deal. Bank of America said, we really like the product. It works. We'd like to make an introduction to one of our security software vendors. Yeah. And me being a tech M&A guy originally, I was like, my horse sense went up and said, hey, this could be an M&A. And we turned it into an M&A, and we got 4 different M&A offers from McAfee, Symantec, and a couple of private companies. We sold to a company called Zone Labs, which got bought by Checkpoint Software. So that was my second journey in entrepreneurship, and my confidence was getting a little bit better, but still not great enough because I'd never built something that was truly profitable. I just was getting profitable exits back then.
Yeah, but it's for many entrepreneurs is the ultimate goal, and you did it twice before you felt comfortable with being entrepreneurship. That's what you are trying to tell me.
Pretty much. But I would tell you that also I was fortunate. I mean, these were quick journeys. The first one was 2 years. The second one was a year long.
Super quick journeys. Yeah.
Super quick. A lot of fun. Lots of learning. And then you asked me about how did I get into macromedia? Well, after taking a little bit of time off on after my second journey, I got introduced to the chairman and CEO at Macromedia. Macromedia at the time was an independent, publicly traded company. And a lot of you guys around the world that were using designer developer tools like Dreamweaver, building websites, would know that this was built off the Flash player, which was a ubiquitous piece of technology. And when I met the chairman CEO, he said, hey, Brian, you seem like a really entrepreneurial deal-making guy. I want to get Macromedia into the mobile space. How about spending half your time on an airplane and buy companies and then help me sell the business either to Microsoft or Adobe? And I thought, hey, that sounds cool. So that's what happened, because that was actually one of the first times I was ever really an employee. And fabulous experience. I love the people I got to work with, bought companies all around the world. And yes, we did end up selling the Macromedia to Adobe for $4 billion in 2005.
That's awesome. So you were you had the chance to observe the company at a totally different stage of life cycle. I mean, in this classic book, Inside the Tornado, Jeffrey Moore is saying that there is this bowling alley where the company is going full speed, acquiring, shipping, doing everything at max. And I suppose it was the times that you were at Macromedia. So what have you learned during these years? The one key thing.
No, I learned a lot. It's a great question. The first thing, and this is maybe more personal, is that I was born an entrepreneur and I never make it in a big company environment because I don't like big politics. I march to the beat of my own drum. And I think that happens with a lot of entrepreneurs. But more importantly, professionally, I learned how companies acquire businesses. So it's one thing when you're a Wall Street tech M&A investment banker doing sell-side work, right? It's a completely different thing when you're on the other side and you get to understand the inner workings of how companies have a champion and put together a business plan and ultimately work with the target company in buying and unlocking synergy. So that was really great. And then the third thing is, just how business planning and strategy, how these things work in big organizations, how sometimes companies can suffer from not invented here syndrome. There's all sorts of things. And I'm so glad I got to do it because it was, at the time, Macromedia was a great internet company. And I really did love the people I worked with.
That's awesome. And you said that let's put Macromedia away for a while. You said that the only third company was the one you felt comfortable with, founding the one. So it was after Macromedia that you started this. Was it FounderPartners or it was before?
No. Okay, so after the sale of Macromedia to Adobe, I didn't go with that deal. I didn't go along with Adobe.
Gotcha.
I started my third company, and I met these two through my founder at the first two companies I worked on. These two very smart scientists, Russian scientists, they're brothers. They had over 60 patents between the two of them, and they created a really interesting piece of semantic technology back in 2004. And it was basically the metrization of keywords that became part of a platform. And they were trying to figure out how to use that technology and where to monetize it. And the idea that we were kind of basically bootstrapping this in the background in the evenings. Trying to figure out where to go. Well, one of the things that happened in the internet ad ecosystem was Google bought a company called Applied Semantics, which became the engine behind AdWords and AdSense. And this company, which was ultimately called Relevad, and Dr. Yakov came in and his brother Yuri came in, and I said, well, shoot, maybe there can be an alternative. So I jumped in as a co-founder. I was basically the business guy. And this was a platform company built on semantic technology. And our first product on or web service was basically AdSense in a box, basically OEMing it to the 300 plus at the time internet ad networks that were around, right? And then we had 5 other product lines. We ended up growing that business to 20 million in revenues and 10 million of EBITDA. Yeah, with only 250,000 or something like that of outside capital from basically friends and family. So closely held business. And in that 20 million in revenues, we had over 10 million of EBITDA. So I learned in that journey, that was an 11-year journey. I was very involved the first 4 years, getting the company to profitability. And then I started playing a little bit more of a passive role as we built out a sales and marketing engine there. Fabulous experience. We had 5 or 6 different product lines. We had 7 inbound M&A offers, including Google, Microsoft. I assume that these NDAs are well past due. And it was just basically became a dividend-paying business. And it was fabulous for me and for my partners, and for me particularly because I then learned if you fight hard enough as an entrepreneur and you're scrappy, you can get a company to profitability. And revenues should lead costs in many ways, which is orthogonal to the way that a lot of people think here in Silicon Valley. But if you have a profitable business, you can actually have an infinite amount of time to figure out what to do with that business. So yeah, great experience. Loved it.
Awesome. I'm happy you said that, and it naturally led us to the founding partners story, because from what we already hear from you is that you had at this stage you had a great experience with exits, with super quick deals. Look, 2 years, $50 million exit is something a lot of people are dreaming about. But then you also did this let's say long-term, maybe mid-term journey with relevant. 11 years is a lot. Profitability, succession, everything combined. So you had this perspective from two different angles. I mean, quick exits versus building profitable machine of printing money. I'm joking, dividends. So it's a super healthy business. And then you started FounderPartners.
Yes.
Which is for me as kind of connecting those two perspectives into single entity, helping entrepreneurs. And how do you help the founding partners, the entrepreneurs, and what was the mission like?
So it was basically FounderPartners was kind of a long time in the making. The whole idea behind FounderPartners was, for me personally, to build a different financial services organization, one that would help a lot of founders throughout their journey of entrepreneurship. And, it's really hard, to basically be a founder of any company. But if you can get help, like real help, and we'll talk about what that means at FounderPartners, from seasoned entrepreneurs, folks that have actually done that many times before. They're real mentors, but they're also in the trenches with you because they're on your cap table. They can help you avoid a lot of the mistakes. So it's basically what FounderPartners is really targeting are global technical founders that want to build and exit their businesses with basically a minority co-founder in the journey. So we have this platform where we build businesses. And on the building side of the businesses, we have these serial entrepreneurs that come in different categories, different ways, and we sell businesses. And there we have kind of the former version of myself early on, ex-tech M&A bankers who turn corporate development folks and maybe become CFOs of companies who are deal makers. And stitching these two professional skill sets together, we at FounderPartners are able to cover the full arc of the company build, right? And so our mission at FounderPartners is to build something that's truly global, that is also multi-generational. It's for founders, built by founders. We're very, very different than a venture capital firm or accelerator.
That was my next question, actually. What is the difference between you and VC, or you and accelerator, you or, kind of Y Combinator, or, all sort of different programs you have?
Yeah, totally. So, and there's a lot of ways to kind of skin the cat in this entrepreneurial ecosystem.
Yeah.
We are a new category. We're pioneering what I think is a better financial services organization. So we're different than a venture firm in the following ways. Number one, a VC manages other people's money.
Yeah.
Live off of management fees. Their true bosses are limited partners. And we at FounderPartners are true principal investors. We don't manage other people's money. We, on the builder front, have created our own capital over the years, and so we're only using our own capital.
Gotcha.
So we don't, have to go report to LPs, do market to them, and force M&As. Or do things that are not congruent with what the founder wants.
So you also don't work in in a scope of funds, right? Which is typical for VC. You have a fund, you have 10 years or 7 years, you need to raise money, invest it, and then exit. And it's absolutely not your way, because it's more like evergreen investment, like investing all the time with your own.
We have no timeline. We don't have any timeline. And that makes us, I think, better aligned with the founders, because it's real founders with founders. And, sometimes founders have different perspectives. Sometimes they actually do want to get an exit early, or the money's too great and they're young and they have a mortgage or whatever. We can work with this. It's super easy. We're super flexible. And I think the other thing that we're different than VCs is oftentimes VCs could have, financial investors. They could be people that have come straight out of McKinsey, right? They've never actually founded a company, or not to mention being serial founders. So they can't be fully empathetic. I'm not saying that about every VC, but there are a lot. Or they could be bureaucrats, for example, which is not necessarily the right thing. Now, we're also very different than accelerators. And, I have to hand it off to Y Combinator and other firms that have done a fabulous job. But we're different in the sense that accelerators teach people mostly how to raise money. We teach people, founders, how to build a business. We're not a one-size-fits-all, program. What batch are you part of for the next 2 months, right? No, our journey can last it's not 2 months. It could be 2 years to 25 years.
You probably, contact the companies at totally different stage than accelerator, right? Because the best value of accelerator, as I understand it, is on the very early stages, where they really can accelerate you. And if you have a business which is growing or which is having operational problems with growth, I suppose that they could struggle helping you. And founding partners, is it the right choice for me? Like, let's say I have a company for 5 years doing 20% of growth. Like, what numbers should I have to be a best fit for you?
I'd say we have 4 different product lines. We have an early stage product line, a growth product line, a passive investment product line, and an M&A product. In the early stage product, a founder could actually join FounderPartners, or they can go to an accelerator. We do a lot of the same things an accelerator does, but we actually customize it for that company. You're not part of a huge batch. Yeah. And we can get your company to profitability, and we come in as minority co-founders. So totally different. And our growth product, yes, maybe a little bit later stage could be a profitable business, and we help them scale it even bigger. And then, of course, we've got an M&A product, and we make passive investments. But a lot of I'd say kind of our meat and potatoes is early stage companies.
That's awesome. So we are trying to evaluate the potential of the business, and the stage on which they are is secondary.
That's right. I mean, I guess one thing that you asked, you said, what are we really targeting? I talked about the global technical founder, but we're also not hunting for unicorns. We're hunting for mustangs.
Mustangs. Yeah.
Yeah.
What's the difference? What does it actually mean? What is the Mustang?
A Mustang to us is probably a company that is going to ultimately exit between 20 to 100 million.
Okay.
And a unicorn, as we all know, those are the $1 billion things.
Yeah.
A $20 to $75 million exit is probably not that interesting to a venture firm because it isn't going to move the needle. It means a lot to the founders. And it means actually quite a lot to us too, because, we're using our own money.
Yeah.
And the other thing I would say is, you never know, every once in a while, a Mustang may grow horns in between its 2 little ears. and it can actually become a very, very big outcome.
Yeah.
But, the reality is that there's, out of every 10 companies, we think that there's a lot of money out there that it may be flooding companies that are supposed to be Mustangs. And the money that's being put into these companies are forcing them to do unnatural things.
Yeah.
And so we believe let Mustangs become Mustangs. And unfortunately, the media, tech media, which is highly influenced by institutional capital, is trying to promote unicorns, when the reality is that there are there's so few unicorns out there, and there's tons of great Mustangs. And so we are big fans of the Mustang.
Yeah, on the pre-call we had 2 weeks ago, you said something I really like. I mean, VC is like jet fuel, and you need to be careful if you are a fighter pilot and have a jet to tank it. And I totally agree with this point of view, because I saw a lot of great companies having profits, having sustainable business, maybe even growing a little bit too fast. I mean, too fast to stay as Mustang, and they felt that they are unicorn, got this VC funding, step into one-way direction of doing next rounds, because VC is always, interested in doing this next round, right? And you as a business doing this few hundred million and maybe few million on EBITDA, you have different situation. For you, the next round, is not always the best thing to do. And if you get into this one-way direction, you think totally different criteria of making daily decisions. Because raising money is the ultimate goal. And I suppose this is tanking the jet fuel, right?
Yeah, I totally agree with you, Piotr. I think you bring up a really good point. I actually think the ultimate goal is not raising money, and sometimes too much ego gets involved in these things, and ego is it's a disease.
It's so cool to have this unicorn-like valuation, Brian.
Yeah, but who cares? At the end of the day, what's more interesting is actually generating cash flow from your customers and following the customer journey versus necessarily institutional capital's requests. Now, there can be a time and place to take institutional capital, and I've been both venture-backed and bootstrapped, and I've done close to 30 companies. I've had 11 exits.
Yeah.
And I can say with my own data, and also as an M&A guy, doing over 100 exits and looking at thousands of cap tables, at the end of the day, what it comes down to is the waterfall analysis. And the waterfall analysis is at the exit. What happened to the common equity guys? What happened to the seed folks and the other things? So I just go back to some companies make sense for jet fuel, others don't. Be careful what you wish for, but also know what you really want too.
I suppose that if you are under 30, you just want to be a fighter pilot. That's it. I think it's a matter of ego very often, because if you are under 30, you haven't seen how is to build a true business, and you built a few companies and doing a lot of M&A, so you saw it, and your data set is pretty wide. I think this is something which is a missing puzzle very often.
It's so funny. I totally agree. Even I was that. When I was younger, I just didn't know any better, right? Pardon my French. I was, I did Navy ROTC, and I remember as a kid, remember Top Gun, and Maverick, and I wanted the pretty girl and all that stuff. And but the reality is that I ended up finding that I had to wear glasses. I couldn't take the jet. And things can change in life, and we need to just look to other founders, also know yourself to figure out what's the right journey. Keep learning.
Yeah, that reminds me a story of frontman of Iron Maiden. Not sure if you are aware, he's a jetliner pilot. He just works on very niche airlines. I forgot the name because it was so niche. But he was also carrying on the Iron Maiden for any concerts they have with their own B761, I suppose, with huge Boeing. So he didn't want to be a fighter pilot, which is actually great for fans of their music. But
that's so funny.
Let's put it away for a while, and let's get back to founding partners, because you said you have those four product lines, and I suppose the scope of your support regarding any of those four product lines is different.
Yes.
But maybe you could tell us more about this model where you have this persona from founding partners, this partner being assigned, helping with operation, because we discussed this before on one of our previous calls, and I really like it, and I think it's pretty unique. So if you can tell a little bit more on that would be awesome.
Absolutely. So first of all, I'd say there are, talent is, the world is flat, and talent exists everywhere. One of the things that we've gotten really excited about in our early stage product line are finding these global technical founders in different parts of the world, where they're not hanging out here on in Silicon Valley, right? Here's a really interesting case study. There was a company called Clean Shelf from Slovenia. And I met the founder, very talented founder named Dusan Omersevic, product guy, who's also VP of engineering from a previous venture-backed company in the ad tech space. And Clean Shelf was originally a system of record for SaaS spend. I discovered Dusan when he was sitting in his office in Ljubljana, and I started essentially internet business dating because I thought that the product looked really interesting. And I was taken away by Dusan's vision for the business and the space. And, I convinced him. I said, hey, look, what you've got here, he had at the time 5 paying customers, paying about $20 a month. So very small business, initial product market fit, great product guy. I said, come to the United States. And come to the United States for 2 reasons. One, it's the largest commercial market, and we could get business moving a lot faster. And number 2, all the M&A buyers are going to be here. So you might as well, like Delaware, see your company, look American, and spend time here, and we can help you grow your business. And he said, oh, that's really interesting. I'm looking at maybe an accelerator. I said, well, here's the difference. So he came out to San Francisco. He met some of our other partners. And the idea was that what we do at FounderPartners was to come in as a minority co-founder and put 2 very seasoned founders working with him week in and week out, and also put in our own capital.
It's always like two forks, like it's a rope.
Yes. So because we don't, again, unlike venture firms, not to mention accelerators, one of the things that makes FounderPartners very different is that we have a very concentrated portfolio. We have an 85% success rate, and the reason for that high success rate is because of the way that we work. So Dusan would meet with our team every week, like every Friday, and just like a minority co-founder, go through what's going on in marketing, sales, product development, finance, KPIs, capital raise, all that stuff. And when Dusan first came out to Silicon Valley, we set up about 30 or more customer discovery meetings. And we realized that, $20 a month per customer doesn't make sense, or a $200 ACV doesn't make sense. So we grew the ACVs from that $200 to like 30,000. We changed the product marketing messaging because we did through the customer development, the go-to-market, putting in the sales engine, putting in the capital. And we were within a few years or so able to help grow that fledgling business to almost $1.5 million in ARR, raise more capital. And the business just got acquired a few weeks ago by a German unicorn software business called Linux. So, what we're doing at FounderPartners is we're coming in as minority co-founders on both the early stage and the growth stage product lines to help those businesses. We even just did one, I can now announce, in Poland, in the beautiful country of Poland. We are working with a landing page company called Landingi. And the founder, I don't know if you know, Blazej, he's fabulous. And
Blazej is in this business for, like 10 years or so? It's pretty long run.
Yeah, and he's done a brilliant job. And what we realize is there are some players in North America that are much bigger. And by helping Blazej, and you can talk to him, like, what are the things we do? The way that we are working, we're unlocking that revenue and that value a lot faster. And we'll put them in a much better position for exit when the time makes sense. And so yeah, that maybe, I don't know if that helps you get a better sense for some of the things that we do on the builder front. Happy to go deeper on it.
Yeah, I think that this is cool, and this is really unique. I really like this model with you partnering with the founders on weekly or daily basis, like helping them to to format the product, find the market fit. I think this is really important. And if you are from small country like Slovenia or relatively small country like Poland, it's very difficult to have this feeling, like what to make to fit to US, which is ultimately the biggest market. So I think that's important. But the second reason you gave us to move to US, which was the acquisition process, the potential for acquisition actually, is even more interesting, because I just figured out that you said that CleanShelf was bought by a German company, and I just figured out that if you are in States, you can be acquired by both US companies or European companies, or maybe even Asian companies, not a problem. But if you are in Europe, you can be acquired by European companies, and the companies from States are, they still can do that, but they also can acquire some folks from US, which is the really great number of companies to be acquired. So they always choose the easiest.
Well, actually, so I would say in the case of CleanShelf, we had 4 M&A offers in addition to the German one. They were all U.S. companies. So what we're doing here is, this kind of goes back to my thesis. When I ran corporate development at Macromedia, and I have friends that do corp dev at a lot of the big tech companies here in Silicon Valley. If you've got 2 companies, company A and company B, and they both have got the same traction, same awesome founders, but one happens to look and feel and smell and be local to the US market, and the other one is all the way out on the other side of the world. Well, the reality is, VMware, who might be the acquirer, is perhaps going to be a little bit more comfortable with the company that's here in the US, because they can grab, a cup of coffee at Starbucks and get to know that person, versus the company that's got a completely different legal system, financial system. There's just hair around it. And it's not that the company that's not in the US won't get bought. It could get bought, less likely. But even if it is bought, it's bought at a fraction, like maybe 10 to 25 cents on the dollar compared to the US thing. So, what we're trying to do at FounderPartners is break that arbitrage. And the other thing I would say is, a lot of European companies, for example, let's say they're in Poland, they want to come to the States. Well, yeah, you can hire a salesperson, but I've talked to plenty of PE firms from Europe that do that, and you just go through so many salespeople. It doesn't make sense. But if you have a true seasoned serial entrepreneur from the FounderPartners balance sheet, they'll come in and act like a real partner that helps build out the sales and marketing engine. They're not going to abandon you. They'll make it happen, because we want to continue to improve on our 85% success rate that we've been having for 20 plus years.
Gotcha. Yeah, that makes perfect sense. And thanks for explaining this, because I think it's not that obvious thing, but when you think for a while, it makes a perfect sense. How long it usually takes for a company founder to do a successful exit? Of course, we are not talking about the success stories you had. I mean, 2 years, I think it's not average, I'm asking about the average timing, like how long it takes. I'm founding a company today, when I will have a successful exit.
Yeah. So the first thing I would say is, I'd say to any entrepreneur, is get your company to profitability and then profitable growth. Because once you've got that, you can dividend, you can already start realizing mini exits for as long as you want. Then when it comes to strategic exit, this could happen, depends on where you are in the market. If you're in a really hot market, it can happen within 2 to 5 years. Sometimes it can be much, much longer than that. The best way to set yourself up for the exit, and this goes back to our M&A advisory stuff, and what I've seen over the years is to put into place, founders should be thinking about their markets and who the natural strategic acquirers would be. Get on the radar screen of those acquirers. How do you do that? Well, you reach out to them and you form strategic income statement relationships with them. And that can pave the path to a higher probability exit at a higher price. Why? Because you as the founder are already building good chemistry, and you're already proving out the synergies with those different types of parties. And, you'll never know that if, one day that potential acquirer says, hey, Jane Sue, would you be open to an acquisition here? And we've got this great OEM relationship or product integration. Are you open to that? Well, then Jane is going to say, yeah, I'm interested. That could be actually quite interesting. That could be great. What are you thinking? But at the same time, Jane may have all these other relationships and other income statement relationships that can create to a competitive process to increase the probability of an exit at a high price. So back to your question, it's not an easy one to answer. These things can happen within shorter time frames. They can be in longer term time frames. But if founders have a profitable, growing business, then they shouldn't necessarily have to care about what that time frame is.
Yeah, absolutely. I think that this urgency to sell the company is not making any good to you, to your company, or to any potential acquirer.
Yeah, we also say on our advisory side, you should read an article that's on our website about the top 10 things that we've learned in selling over 170 companies in tech, and distilled down in this 2-pager. One of the things we say that founders screw up exits for 2 reasons. Number one, they either miss the window because they've got their head so far down in the sand, they're not actually thinking about the macro. And then when the music stops, there's no chair for them to sit on. And then the second reason is that they inadvertently say the wrong thing. And inadvertently, because they're dealing with very sophisticated corporate development deal makers that make their lives to try and get the cheapest price by playing tricks all the time on unsuspecting founders. So we'd like to be able to help those founders in that process, because in an exit, it's almost a travesty that you can spend as a founder years and years building your business, but in an exit, you can actually leave so much money or gain so much in a much shorter period of time relative to the build.
Absolutely. It's totally different than building a company, like selling one. And
yes.
That's funny thing, because this year we succeeded at Devante with Tom, so we are not longer engaged into daily business of the company. And after 13 years, my observation was, I shared it with Tom, and he agreed with me. My observation was that if you are entrepreneur or even employee or some very important, C-level executive, and you had a really, really bad day at work, you can lose like full day of work, maybe a week or month or 2 months of your team's time, doing something totally stupid. Mm-hmm. But if you have a bad day and you're an investor or maybe selling company, you can lose everything, because the decisions you are making are so important, and have effects in such a long time.
Exactly, and that's what one of the things we try to do at FounderPartners, and we stitch together these 2 practices, especially the M&A advisory. We not only help our portfolio companies from early on start thinking about M&A, but we actually work with a lot of clients. When that founder who just gets an inbound is like, whoa, how do I answer that? We try and help those founders, because we hope at some point those founders can help give back through the Founder Partner platform to other future founders.
That's absolutely awesome. Okay, Brian, I don't have more questions. So it was great talking with you. Thank you for your time.
Thank you, Piotr. It's so great. I really love what you're doing with your podcast and your brother. You guys are very special.
Yeah, it was awesome. Thank you for your time.
Thanks for listening to the CTO-CTO podcast. Make sure you subscribe us and check out our website, CTO-CTO.com, where you can find all of our previous episodes and filter by category and find exactly what you're interested in. See you next week.